Hi, good morning, everybody. So I'm going to spend the next 20, 25 minutes or so giving you a quick run through of highlights in the investment world. There's a fair bit to get through, so I'm just going to dive straight in and start off with a bit of the macroeconomic background. Now, to put this into some context, if you can cast your mind back about 12 months or so, there were three big issues that were occupying the minds of investors. So the first of these really was inflation, and that's all, a lot of what we've been talking about over the last probably 2 years or so. So if you can look at the chart on the right-hand side here, you can see just how much of a peak we've been through. This is showing year-on-year CPI growth. Now, going into 2023, we just passed that peak. So inflation was still at very elevated levels and really top of the minds of central bankers and governments was getting that under control. So a second consideration then linked very closely in with that, of course, is in order to fight that inflation, central banks were going through some pretty steep rate rising cycles. So the Bank of England rate peaked at 5.25% in August last year. That's remained there ever since. So investors were really focusing on how high rates were going to go, when that peak was going to occur. And then connected to that, can we go through that rapid cycle? Been off the back of ultra low interest rates for over a decade prior to 2022. Can economies withstand that increase? So there was a big focus on, to what extent are economies going to be pushed into recessions to fight inflation. So if we fast forward up to the present day, we can see kind of how we fared in that environment. So I've included a chart here on the left. You have your GDP growth, quarter on quarter for the UK, US, and the Eurozone. So, a quick word of caution here. International comparisons are notoriously difficult when you're looking at GDP. I'm going to do it anyway. But so looking at the US first, really what stands out to me is just how resilient the US has been compared with the UK and the Eurozone. I think a big driver of that you can see from the inflation chart. So inflation's been affecting the consumer massively. You can see the light green line here, US's peak in inflation was much earlier, so about 6 months earlier, and considerably lower than we saw in the UK. So that lowering inflation, by 2023, that was starting to feed into more consumer confidence. And actually, consumers had the confidence to start winding down the excess savings that they'd built up throughout the pandemic. We saw that in the US to a much greater extent than happened in the UK or Europe. And it's really that which has helped to drive that economy forwards in 2023. If we turn to the UK, so you're probably aware that based on the provisional Q4 figures from the ONS, the UK is now in a technical recession. So that's 2 consecutive quarters of negative growth. Now, probably wouldn't panic about that. It's just a kind of technical definition. And also, we have a pretty strong history of these numbers being revised considerably. So it might well be that the recession disappears in a few months' time when we get the final numbers. But it is kind of illustrative of the broader picture in the UK economy, which has been one of stagnation, really, since the beginning of 2022. So you can see some pretty anemic growth figures quarter on quarter here. And again, I guess if it brings us back to the inflation chart here. So UK's position was much higher spike in inflation quite a bit later. That's really damaged consumer confidence in the UK. So consumers have been facing higher energy bills, higher food bills. Linked in with interest rates, we've got higher housing costs. And that really has put a dampener on spending as incomes have not been able to keep up with that. And that's really still the environment that we find ourselves in today to some extent as well. I guess some slightly more positive points. The UK is not an outlier. I mean, if you can treat this as a positive, so our European neighbours, a lot of them are in a similar position. So Germany's just seen its economy contract by 0.2% for 2023. France, again, is experiencing some pretty similar economic stagnation, particularly over the second half of 2023. So it's nice to see that we're not on our own. But probably the big positive, again, I'll draw you back to the inflation chart here. is really those numbers have come down really substantially, and there's definitely a much more positive feeling that we're past the worst of this inflation spike. So, I mean, the UK CPI is currently running at 4.2%. That's higher than the Bank of England would want it, but it's getting much, much closer towards that CPI target of 2%. So generally a bit more of a positive backdrop as we go into 2024. So moving on to equity markets. So you'll probably be aware that although equities are sensitive to what's going on in the underlying economies, they don't move in lockstep with GDP. The equity market's much more forward-looking. And we saw a really strong year in 2023, kind of across the board for equity markets. So I've got two charts on this slide. At the top, we've got the 2023 returns across the UK, US, Europe, Japan, and emerging markets. These are in local currency terms. And then I brought it up to date at the bottom here. So this is your returns from the end of 2023 up to last Friday. So you can see a continuation of some really strong returns in markets. And actually the drivers of this have been pretty consistent throughout. So if we think about the US, which is one of the standout performers at giving 27% last year. So in the US, I spoke about inflation's coming down, consumer confidence is building. It's driven a really risk-on mindset from investors in the US. So you're seeing your cyclical stocks, those your economically sensitive stocks, outperforming the more defensive ones. So thinking particularly about consumer goods, financial services, are outperforming sectors like consumer staples and healthcare. Probably the biggest driver, of course, has been a boom in the tech sector, and that's really been driven by enthusiasm for generative AI models. And 2023, for me at least, was definitely the year that AI made it really mainstream. I think in my inbox, not a day went by when I didn't have an email about AI revolutionizing some industry or another. And this has really been feeding into the stock market. So the tech sector has really driven that boom in the US, and in particular, thinking about the what we call the Magnificent Seven set of stocks. So these are the 7 companies, tech-focused companies in the US. On and off, they're the biggest 7 companies in the index. So that's your Apple, Microsoft, Amazon, Tesla, Nvidia, Meta. Might have missed one there. I stopped counting. But these have really been important to returns in the US. So, I mean, as an example, Nvidia is probably the purest bet on AI in that 7. Their stock price rose by 254% over the course of 2023. That's continued into 2024, and it actually recently set the record for the biggest stock price rise in a single day. Combine these 7 stocks, it's estimated they delivered more than 60% of the total index return in the US. So obviously that's great if you're holding the stocks. It does raise some concerns for us around concentration risk. So, there's 7 of these stocks. Some of them are bigger than the whole of the UK market. Holding them combined, if you're holding a US equity index fund, which you might expect to be pretty well diversified, about 30% of your holding is in these 7. So if they were to start moving down in a synchronized fashion, you might find that this performance unwinds pretty quickly. And that's something that we're cognizant of when we're building equity portfolios for our clients. Okay, so that's the US. I guess I should touch on Japan quickly as well. So there's a kind of different set of factors for Japan. I mean, this is quite out of character for the Japanese market. After decades of stagnation, we've seen some really big returns this year. Japan is much more of an outlier now in terms of its ultra-low interest rates, which has driven weakness in the yen. And it's also benefiting from a flight of capital from China, where there's a slow burn real estate crisis going on. So Chinese returns dragging on that EM market, but also driving returns in the Japanese market as well. And that's continued into 2024 too, with some pretty large returns for just a few months. And actually the Japanese index recently hit a historic high, which I hadn't reached, which was set 34 years prior. So, I mean, that's an illustration of just how stagnant that Japanese market has been. Turning to the UK, afraid it's not a great picture in the UK. It has lagged behind the rest of the world. You know, there are structural considerations in the UK market which make this not too surprising. You know, firstly, we don't have exposure to those big tech companies, so we've not really been able to partake in that AI-fueled boom. Secondly, it is more defensively biased, and there's a particularly large holdings in energy and mining sectors, which have been dragged on by falling commodity prices. And also, in a mirror image of Japan, you know, high interest rates in the UK have driven strength in sterling, which starts to drag on the returns of multinationals as the value of their overseas earnings becomes worth less once you translate it back to GBP. Okay, so moving on to interest rates. I wanted to just touch a bit on the gilt market. And so here I've got the gilt yield curve on the left-hand side. And that's presented over 3 dates. So the red line there is your 30 yield curve at 30th of September. 31st of December then is the dark green, and then pretty much up to the present day in the dotted line. And I guess one thing to note about this is just how volatile the yield curve has been. This is a continuation of the pattern we've seen since the gilts crisis in 2022. And just as an illustration, if you're holding a simplified illustration, if you're holding a 20-year gilt, you'd have had a yield of, you know, approaching 5% on the 30th of September. That then fell by around 80 basis points over Q4 to about 4.2, and then, you know, about 2/3 of that has been kind of regained in yield terms, moving up to the present day. So if you're holding that 20-year gilt, obviously you've seen a big movement in the yield. That's a really big shift in terms of returns as well. So you're going through a very volatile moment. If you want to understand kind of what's driving that, it's probably best to look at what's going on the inflation curve. So this is kind of the implied path of RPI taken from pricing in the index-linked gilt market. And what you can see here is that there's been a really substantial shift in the kind of market pricing of RPI over Q4 2024. So looking at that red line for 30th of September, you can see that markets were thinking inflation is going to be running much higher and it's going to be much stickier over the long term at that point. Q4 then saw some pretty, saw CPI prints inflation prints surprising on the downside, which caused a big reassessment basically. The yield curve then really shifted, so the inflation curve shifted substantially, taking us down to a pretty flat inflation curve at around 3.4, 3.2%. Once you allow for the known difference in CPI and RPI, that takes us much closer to that 2% target for inflation over the long term. So worth noting, I guess, as a first point, that's a really big shift in inflation. So for pension schemes who are hedging inflation, it's probably worth assessing your inflation hedging arrangements at this point, because we're finding with a few schemes that is causing it to get a bit out of line versus targets. But then just to comment on how this feeds into the gilt curve, with inflation expectations coming down substantially, the market view is then turning to, do central banks have room to cut interest rates now to support the economy? And the best way to look at this is just by looking at the short end of the nominal gilt curve, which is highly influenced by that expected future path of the base rate. So we've moved from September 2023, a relatively shallow rate cutting curve. Markets then got very excited and started to price in a pretty sharp drop in rates, bottoming out in about 5 years at 3.2%. I think that turned out to be that was reassessed, and it turned out to be a bit over optimistic, and I think that explains why we bounced back a bit somewhat in the interim, getting closer to here. But it's interesting to look at the inflation curve, which really hasn't budged, and I think that suggests that markets think that inflation really is kind of coming under control now, and it's becoming less of a concern for investors. So, in terms of what this means for investors, I guess one thing to note really is that despite this volatility, gilt yields do still look really attractive relative to recent history. So it's been a continuation of the theme from 2022 with our clients. We're recommending, if you haven't already hedged, pretty high percentage of your liabilities, now is a great time to do it, especially when you take into account that volatility that we're seeing. For an unhedged scheme, that can have some pretty large impacts on funding position. And we're not anticipating a huge rise from this point. So probably better off starting to lock in those gains. Okay, and then thinking about where that gilt curve might end up longer term, one of the big determinants of that will be what happens to the base rate over the long term. And I've plotted the Bank of England base rate going back to 1990 here, and you can kind of see from this chart that we've got, broadly speaking, two regimes, interest rate regimes in that period. So we've got this period in the 90s where the base rate kind of averaged at about 6.4%. Then the global financial crisis happened, and we see that there was a big shift. And actually, in the following decade or so, up to 2022, the average base rate was 0.5%. So that was the era of ultra-low interest rates. It really feels now as if we've moved out of that, and we're going through another regime shift now. And the question will obviously be, where is that base rate going to end up long term? That's going to feed into gilt yields. It's going to have an impact on pension scheme liabilities. Now, if you look at current market pricing, that would put that long-term average at somewhere around 4.5%. Although, given the volatility in the market, that could well shift substantially week to week. So I wouldn't read too much into that. But I think the general view of economists is that we're not going to be going back to this ultra-low rate here. We're going to end up somewhere between these two steps, essentially. So I think that will be broadly good news for fixed income investors. So the yields on offer from your bond investments are still going to be substantially higher than they have been in recent history. Good news for pension schemes as well, in that those healthy funding positions will hopefully not be rolled back too much. But yeah, so I guess that's what I wanted to say on interest rates. Bringing this together a bit and thinking about outlook. So I've mentioned that we've seen inflation falling. Markets now shifted its focus to when interest rates are going to come in and to what extent we'll see those interest rate cuts. So there's a generally improving environment from a macroeconomic perspective. Now we've seen the UK go into recession, but I think given that positive backdrop, it feels like where economies do go into recession, it's likely to be relatively short-lived, relatively shallow. So the base case I think that we're working with is that we're looking at what we'd call a soft landing scenario, where interest rate peaks have not choked off economic growth too substantially, and economies recover quite quickly. And that's certainly consistent with what the IMF has been projecting. So this map on the right here is their real GDP projections for 2024. And you can see from the swathes of green here, you probably can't make out the key. Essentially, green is good. It means they're projecting almost every country will increase its GDP in excess of inflation. So consistent with that kind of positive soft landing outlook from the perspective of economies. It's certainly what markets are pricing in, I think, at the moment. It's worth noting, of course, that given markets have priced in this quite positive scenario, you might not see a repeat of last year in terms of return, unless there are some positive surprises. I think our view would be that actually risks are skewed more towards the downside. So, we've still got elevated inflation. It could prove stickier than expected, particularly in the UK. Wage increases are running quite high at the moment. So you might see central banks the Bank of England in particular step in or keeping rates higher for longer than is currently anticipated. In particular, we also have a number of geopolitical hotspots at the moment. So obviously the Russia-Ukraine war is ongoing. There's big potential in the Middle East for that conflict to escalate as well. We're seeing tensions in the Red Sea disrupting shipping already. So probably the most obvious way that could manifest itself is more disruption to supply chain, which could then put us back into that inflationary cycle. Markets have proven that they're quite sensitive to the timing and level of rate cuts as well. So any kind of change in that expected path, you could see quite big market moves. But generally a positive outlook, and I think we're in a world of high yields as well, so still good news for fixed income investors. Okay, and just to finish off then, I wanted to say a few words about what we're seeing from our clients at the moment. So I've got on the left-hand side here the PPF 7,800 index. This is just a kind of their plot of the aggregate funding position of pension schemes. It's on a PPF basis, but you can see it's quite a positive picture from this. So if we take it up to January 2022, at the point where yields started to rise, the funding position was still relatively strong here. So, looking at the funding level, which is the dotted line, on the right-hand axis, you had, on aggregate, schemes were pretty much 100% funded on that PPF basis. But since the gilts crisis, we've seen yields really blow out. We've seen, obviously, strong growth returns in 2023. That funding position has really improved a lot, and it's actually sitting at about 140% at the moment. So this is generally quite illustrative of a picture for pension schemes on aggregate, that funding is pretty healthy, and a number of our clients now are finding themselves in a position where buyout is an affordable goal. Actually, they're fully funded on a buyout basis. Where schemes are actually ready to move towards transacting in, say, a 12 to 18 month period, we're moving these schemes towards what we'd call a buyout-aware strategy. So there's a high level of interest rate and inflation hedging, which many schemes have adopted already anyway. But what we do look to do is take out the growth allocation and put in a large credit holding. And that credit, investment-grade corporate bonds generally, that's there to help us better match insurance pricing. So insurance pricing is driven by investment strategy of insurers. That tends to be quite credit heavy. So by holding them, you're more likely to keep pace with changes in pricing by insurers. It's worth noting, though, that actually a lot of schemes, although they find themselves in that funding position, they might not be ready to transact over that kind of time frame. There's a lot of other hoops to jump through. It's also, quite possible we're going to see a huge amount of demand for buyout over the next decade or so. It's possible that insurers won't actually be able to keep up with that demand. So you might find that although you've reached that funding position earlier than anticipated, that actually you then need to wait for longer than you might expect in order to transact. So where schemes are looking to move to buyout over that slightly longer time frame, more than 18 months, 2 years, this is where we're adopting something that's more consistent with a low dependency strategy. So you're still keeping a high level of hedging. You might retain a bit of growth to generate return over the longer term. You still have a credit holding, but here we would focus much more on the shorter term credit. So the focus here would be, these schemes are very well funded, they're not receiving contributions anymore. So the cash flow position becomes much more important. And if you're going to be selling assets to meet those benefit payments, you run the risk that you might be selling at depressed prices. So that can really drag on a funding position. So we're moving into cash flow driven strategies, so short dated corporate bonds that are going to generate those cash flows that you need to meet your benefit payments. So I guess that kind of sums up what we're seeing from our DB clients. Just a very quick word on DC. So obviously the change in interest rates has really changed things for DC members as well. So annuities back on the table now after a very long period of being ignored as an option due to their expense. We'd still anticipate that income drawdown will remain the primary option at retirement, but annuity is definitely becoming a more viable option for many. It's worth also saying as well, we're living in volatile markets, so it's important to be communicating to members to make sure that they're not getting spooked by that volatility, which they can take over longer time horizons. Obviously, we're also seeing that volatility extend to fixed income markets as well, with as illustrated by the gilt yield curve earlier. So it's not just relevant to growth markets. And I think that's all I wanted to cover. Any questions?
Thanks very much. Really interesting.
Thanks.
If you had a crystal ball, we came back, say, in 12 months' time, what do you think the main issues we might be discussing then?
Well, okay, so yeah, crystal ball, Stuart mentioned that. I think it is a good analogy because there's a lot of uncertainty out there. So I think this kind of rosy picture that we painted about the base case for economies, it does depend upon quite a volatile political environment not throwing things off. So, I mean, I would be quite happy to see that we have started to move into rate cuts, that economies are starting to emerge from this stagnation and consumer confidence is picking up. Quite a few potential issues there, and it's still not impossible that we could be thrown back a few years and actually that inflationary cycle will pick up again. So quite a bit of uncertainty out there, certainly positive central scenario.